As we step into 2026, one truth is becoming impossible to ignore. For years, America's rental market looked unstoppable. From New York to Phoenix, landlords ruled the game. Rents jumped overnight, tenants paid anything just to stay housed, and investors piled in, convinced demand would never end. It felt permanent. But as 2025 closed and 2026 began, that illusion shattered. Across the country, empty apartments spread, incentives exploded, and rent prices began falling in cities that once felt untouchable. This isn't a slowdown. It's the aftermath of a system that finally broke under its own weight. Developers built too much, too fast. Investors borrowed too aggressively. Renters hit their limit. And for the first time in over a decade, tenants are entering a new year with leverage. The question heading into 2026 isn't whether the rental market cracked, it's how deep the damage already runs. What we're seeing now is a nationwide correction playing out in real time, city by city, market by market. Austin, Texas is the clearest example of how fast a boom can reverse. Once the crown jewel of America's tech migration, Austin exploded between 2020 and 2023. Luxury towers rose overnight, rents surged, and landlords couldn't raise prices fast enough. But as 2026 begins, average rents remain down double digits from their peak. Thousands of newly built apartments are still underoccupied. Rooftop pools sit unused. Developers continue offering free rent and waived fees just to keep buildings half full. Tech layoffs never fully reversed. The high income renter base shrank, and vacancy rates hit decade highs. The city that became unaffordable overnight is no longer untouchable. Miami enters 2026 still shining on the surface, but financially fractured underneath. The pandemic boom turned the city into a global luxury playground, pushing rents up more than 60% in just 2 years. Condos became speculative assets instead of homes. Now rents remain down more than 10%, vacancies keep rising, and luxury towers still advertise incentives that would have been unthinkable just a few years ago. Insurance costs have exploded, HOA fees keep climbing, and investors are bleeding cash. Airbnb owners are exiting as tourism softens and costs crush margins. Miami looks perfect from above, but it stands as a warning of what happens when speculation replaces sustainability. Atlanta was supposed to be the safe bet: affordable growth, strong jobs, and endless demand. Instead, it enters 2026 weighed down by overconfidence. More than 50,000 new units flooded the market during the boom, and demand never caught up. Rents remain lower than a year ago, vacancies keep climbing, and landlords rely on aggressive incentives to survive. Wage growth stalled, inflation drained savings, student loan payments returned, and younger renters downsized, doubled up, or left entirely. Atlanta didn't crash in a single moment. It slowly suffocated, and the imbalance remains unresolved. Las Vegas enters 2026 with familiar energy and familiar mistakes. Years of migration, short term rentals, and investor optimism pushed rents higher. But now the market feels heavy. Rents remain well below peak levels, vacancies stay elevated, entire complexes sit half occupied. Tourism hasn't fully normalized, service sector wages lag behind housing costs, and thousands of former Airbnb units remain stuck on the long term rental market. Vegas has seen this story before. Different decades, same gamble, and the odds have turned. Phoenix was built for endless expansion, but 2026 is forcing a reset. Tens of thousands of new units came online in a single year just as demand slowed. Rents fell sharply from their peak and have yet to recover. Incentives remain widespread. Investors who bought at pandemic prices are underwater, and refinancing remains difficult as interest rates stay elevated. Phoenix isn't collapsing overnight. It's correcting slowly, painfully, and visibly. Dallas enters 2026, still growing, but no longer unstoppable. Luxury rents remain below their highs, vacancies stay elevated, and developers who bet on constant demand are recalculating. Inflation reshaped spending, hiring slowed, and renters became cautious. Dallas still projects confidence, but beneath the skyline, the market is far less certain than it once appeared. Boise may be the clearest symbol of the post pandemic hangover. Remote work lifted rents and prices far beyond what local wages could support. When that wave receded, Boise was left exposed. As 2026 begins, rents remain significantly lower than their peak, vacancies keep climbing, and developers sit on inventory they can't move. The Californians left. The locals never could afford the boom. Boise's story isn't just about housing, it's about what happens when growth outruns economic reality. Seattle enters 2026 quieter than it's been in years. Tech layoffs reshaped demand, construction slowed, and rents remain down from their highs. Downtown towers still offer incentives, projects remain paused, and tenants now negotiate from a position of strength. The prestige premium has faded. For the first time in a generation, Seattle feels optional. San Francisco enters 2026 fundamentally changed. Rents remain deeply discounted from their peak, vacancy rates stay historically high, and downtown recovery has stalled. The tech exodus became permanent, and the city's myth of inevitability cracked. San Francisco didn't just lose renters, it lost its aura. The transformation no longer feels temporary, it feels structural. New York City, the market that survived everything, enters 2026 showing real limits. Rents remain well below peak levels across Manhattan, Brooklyn, and Queens. Incentives have returned, leverage has shifted, layoffs, overbuilding, and retreating global capital weakened what was once a bulletproof rental machine. New York didn't collapse overnight, it slowed, contracted, and adjusted, and that alone would have been unthinkable just a few years ago. As 2026 begins, this isn't just a housing story, it's a power shift. Developers overbuilt, investors overleveraged, renters regained leverage. This reset is painful, but necessary. Housing can't defy gravity forever. Some cities will recover, others won't. But everywhere, the message is the same. The era of endless rent growth is over. 2026 isn't the start of a boom, it's the year America lives with what the boom left behind.